Hey, my name's Jake Nicholson and welcome to my YouTube channel. In this video, I want to talk about why some lenders are starting to increase mortgage rates. You see, we had the Bank of England cutting the central bank rate last week, and expectations from most people were that that would mean to lower mortgage rates. But the opposite is happening, particularly with this one big lender. I'm going to tell you why other lenders might also be jumping on this bandwagon fairly soon and what's causing the interest rates to actually increase when the Bank of England is cutting rates. If you're new around here and you haven't done already, do make sure you subscribe to the channel over there and hit that bell notification. We're on the way to 46,000 subscribers. And by subscribing, you'll get all the latest house price news, interest rate news, property news, investing news, and much, much more. And let's get some views on this video, because I think it's important for people to really understand what moves interest rates. So how can you do that? Simple. Smash like, tick or like, do something to that like button. That really helps with the YouTube algorithm, and that really has helped the channel grow. So it makes sense logically that when the Bank of England cut rates, that mortgage rates would go down, but that isn't what's likely to happen. And one of the major lenders is going to be increasing their interest rates this week, albeit by a small amount. And that's due to the fact that the swap rate has actually started to go back up. So first off, what is the swap rate even? In fact, it's got a word in front of it. It's a SONIA swap rate. Now, interest rates that you or I pay, they're not massively impacted by the Bank of England base rate. There is some correlation there. So, for example, if you have a tracker mortgage, that will be based off the Bank of England base rate, plus or minus 1, 2%, whatever deal you've got there. And so if you have a tracker rate and the Bank of England cut rates last week, you will get a lower rate next month. So that will automatically happen because you're on that tracker rate. But the banks that you borrow from and the banks that I borrow from, I'm talking HSBC, I'm talking Santander, I'm talking NatWest, I'm talking the Mortgage Works. Well, they borrow off bigger banks and they borrow on a rate which is called the SONIA swap rate. And that's based off the fact that basically projections on where they think the Bank of England rate is going to go. Now, we've had some bad inflation data coming through, or the Bank of England in the last meeting really revised their forecast for inflation. We're at 3.6% inflation at the moment, and that was where we were expected to stay there or thereabouts for the rest of 2025. The Bank of England, though, when they cut rates in their meeting, said we're expecting inflation to now go above 4%. And that has really worried a lot of people. And that looks like that the Bank of England is less likely to cut rates again this year. Now, they could have one more cut in them, but we're not going to go on a very aggressive cutting cycle. Now, the Bank of England is in a precarious moment at the moment. They've got to look at various things. They always look at inflation, and their main goal is to bring that inflation down to the 2% target. But they're not just looking at that, and they're making that very clear. They're also looking at the GDP. The UK is very close to being in a recession. And more importantly, unemployment is rising in the UK. You've probably seen in the news this week, we've got more people than ever before on benefits. 8 million people are on benefits now under the Labour government. And that's probably going to increase because the budget that we're looking at in October is likely to put tax increases on. That means more people are going to have less disposable income. They're going to spend less in retail stores. They're going to spend less with restaurants. They're going to spend less on hotels. They're going to spend less on holidays. And that's going to slow the economy even faster. And so eventually we will be probably very, very close to a recession, and unemployment will continue to rise. So it's a mess at the moment. You've got inflation going up way more than we expected. You've got unemployment going up a lot more than a lot of people expected. And a lot of that, I think, is self-inflicted because you've got things like you raised the minimum wage, which meant more people lost their jobs. You raised the national insurance contributions. You raised business rates. All of this stuff is anti-business, is not supporting them at a time when things are very, very difficult with energy costs and such like. So what this means is the outlook is really confusing at the moment. While we're trying to get inflation down, and generally you do that with higher rates, we've also got unemployment going up and the economy slowing. So this is a stagflation scenario, and this means that there's less predictability and certainty with mortgage rate cuts. That has meant that the swap rate has gone up. I'll give you an example here on two of them. They haven't both gone up, but in the short term, the 2-year swap in July was 3.61%. That meant that banks that you borrow from and I borrow from could get money at that kind of rate. Well, it's gone up quite a bit now, nearly 0.5% up to 4.04%. And that's as of the 11th of August. So that isn't moving in the right direction. That means borrowing for banks is more expensive. So they're likely to pass that cost on to you. The 5-year outlook, though, isn't looking as bad. And this has actually gone down a smidge. So for 5 years, they could borrow at 3.68%, and that has dropped to 3.62%. So they do forecast there that rates will come down eventually in that 5-year period, but in the shorter term, this is saying they think that rates aren't going to go down as quickly as we expected. So who is looking at increasing rates this week? It's quite a big lender. It's Santander. And so Santander have said we are increasing rates this week. We haven't got the exact stats on that yet. I am telling you now, I believe it won't be 0.5% or even 0.25%. I think it'll be 0.1%. That's what I think that they will do, because the market is still slow. So they're not going to want to price themselves out of the market totally. They want to get business in, but they're having to increase this because their costs of borrowing have gone up significantly, I would say, over the last few weeks. So this could be the start of other lenders doing this as well. And maybe you're looking to get a new mortgage at the moment. You're sitting there thinking, well, rates are coming down. Maybe you should be looking at a rate right now. If you have a remortgage in the next few months, you should be speaking to a broker. You should be looking for the best rates that you can get in the market and locking those in. I used to say this a lot at the beginning of the year, not so much now, but you can get your mortgage rate fixed on your remortgage 6 months early. And what that does is it gives you the worst case scenario. So here's what I'm saying. Maybe you go to your bank right now and they've got a rate that's 4%. Your deal doesn't expire for 6 months from now. So you fix that deal. But in that 6-month period, rates tumble. They go down to 3.25%. The lender crushes their rate down. But because you haven't started that new deal, you can swap onto the lower rate before you start. You might get £100 admin charge. Most lenders will do this. Check with your broker, check with the lender before you sign up with them that is the case with those people. But that gives you a worst case scenario. But what if rates continue to go back up? What if the swap rate doesn't look great and rates go back up to 5%? Well, you've locked in that better deal. So that gives you the best case scenario. In fact, we cover this kind of stuff in our ebook, which about 1,500 people have grabbed already. It's Mortgage Secrets, how to get the best mortgage deal in 2025 and beyond. Do grab a copy in the description of that. Do grab it in the pinned comment. As well as that, smash that like button, please, guys. That helps with YouTube. Comment below with where you think rates are going to go. And also check out all the other content as well on the channel, including this video right here.